Somewhere outside a mid-sized American city, a stretch of land larger than most downtown districts sits behind a chain-link fence, marked only by runway lights and a single terminal that looks unassuming from the highway. Most people never think about who owns it or what it costs to keep a single runway operational. An airport feels like public infrastructure, something that simply exists. But behind that illusion of civic simplicity is one of the strangest, most capital-intensive businesses in the American economy, one where ownership rarely means what people assume, and where the real money is made in ways that have almost nothing to do with airplanes. The first surprise is that owning an airport does not mean owning an airline, and it does not mean profiting from ticket sales. Airports make money the way shopping malls make money, by charging rent to tenants and fees to anyone who uses the space, while airlines absorb nearly all the operational risk of actually flying people around. Airlines pay landing fees calculated by aircraft weight, gate leasing fees for the privilege of parking at a terminal, and rental charges that scale with square footage, negotiated through agreements that can run for decades. This forms what the industry calls aeronautical revenue, tied directly to flight operations. But aeronautical revenue is often the smaller, less profitable half of the business. The real margin lives in non-aeronautical revenue, a polite way of describing parking garages, retail concessions, restaurant leases, rental car counters, and advertising space, all operating on markups that would be unthinkable anywhere outside a terminal. A bottle of water that costs $1 a mile away can sell for $4 past security, not out of deliberate overcharging, but because every square foot of terminal space is leased at rates reflecting a simple truth. Passengers are a captive audience with nowhere else to go and time to kill. This is where airport ownership starts to resemble real estate more than transportation. The land beneath an airport is often worth more for what can be built around it than for the runways themselves. Air cargo hubs, hotel developments, logistics centers, and long-term parking facilities generate steady income that does not fluctuate with fuel prices or airline bankruptcies. Many of the largest airports have quietly transformed into diversified real estate operators that happen to have a runway attached, leasing land to logistics companies for cargo operations that run around the clock regardless of passenger traffic. Ownership structures reveal just how unusual this industry is. Most major American airports are owned by city or county governments or by special purpose authorities, which means profits often get reinvested into infrastructure rather than distributed to shareholders. Private ownership does exist, but usually through long-term concession agreements rather than outright purchase, where an operator signs a lease running 30 or 40 years, taking on terminal operations in exchange for that non-aeronautical revenue. These deals resemble infrastructure investments more common in toll roads or utilities, where upfront capital is enormous, but long-term cash flow is remarkably stable once debt is serviced. And the capital requirement truly is enormous. Building or expanding a single runway can cost hundreds of millions of dollars, and a new terminal easily crosses into the billions. This is why airports are almost never built using pure equity. They are financed through municipal bonds backed by the airport's own future revenue, meaning the entire structure depends on decades of steady passenger traffic to pay down debt issued before a single plane ever landed. What makes airport economics genuinely fascinating is how insulated they are from the day-to-day chaos of the airline industry itself. Airlines can go bankrupt, fuel prices can spike, entire carriers can vanish. Yet the airport keeps collecting fees, keeps leasing retail space, and keeps its parking garages full, because people don't stop flying just because one airline struggles. The airport sits above the turbulence, profiting from the existence of air travel as a category rather than from any single company within it. Owning an airport means betting not on any particular airline winning, but on the simple, durable fact that people will keep needing to get from one place to another.